Hello everyone, welcome to chapter 27. In this chapter, we will discuss the different types of entry models that exist, their intricacies, their details, how do they work, and exactly in which market conditions they are suitable. This is going to be the main topic for this chapter. So let's move on to the next slide. Here in this slide, we're going to talk about entry models in the most detailed way possible. We know that entry models are one of the most important tools in our trading system, right? Because once we've identified our high time frame drawn liquidity and we've waited for an anchor point to form in the form of a candle range, the only thing that is left and the most important thing that is left is now to enter that trade or that trade idea that we've generated with a precise and accurate entry point, stop loss level, and a take profit level. And the way that we're going to do that is through the help of an entry model. A solid entry model isn't just about when to enter a trade or when to jump into a trade. It's about understanding the full context of why you are entering, exactly where you are entering, and how you are going to be managing your risk, right? These are all the different metrics and factors that your entry model is going to consider, right? Now, let's break it down step by step. First of all, let's talk about what is an entry model, right? Now, think of an entry model as your framework, right? It's going to contain a set of rules, protocols, and guidelines that are going to answer three critical and important questions for every trade that you take. The first question is that when to enter, right? We know that in trading and specifically in ICT and CRT trading or analysis, timing is everything, right? That is precisely why your entry should be based on key times. During kill zones, key times, and key macros, those are the only times that you are allowed to enter a trade, right? That is what we call timing or timing your entry or timing your trades. The next question that your entry model is supposed to answer is where to enter, right? And this step of this question is about identifying the key levels and the specific candle ranges on the higher time frame that you're going to frame your entry off of. And along with that, you're also going to answer the question of where you are entering. Are you entering at a liquidity purge or after a turtle soup, or you're waiting for a confirmation in the form of an order block or maybe a fair value gap or an inverse fair value gap, right? That is up to you. The third question or the third most important question is that why to enter that trade idea or exactly why you are entering that idea, right? This is the most important part. Knowing exactly what is the rationale behind your setup or what is the thought process behind your setup. Is it supported by high time frame drawn liquidity? Does this trade idea have a clear time and price based narrative backing it up or behind it? Or you're going to look at other confluences like standard deviations or session profiles, right? You're going to look at all of these factors and metrics and you're going to see whether these confluences or these ideas support your trade idea that you've generated or not, right? These are the three important questions that your entry model is supposed to answer. And when you're looking for a trade or when you are entering a trade, you must be able to answer these questions. And if you're not able to answer these questions, then your entry model is incomplete. So now that we've discussed the three questions that your entry model is supposed to answer, let's talk about an important topic. That is, why does an entry model matter? Right? Now it's simple. We know that because without an entry model, you are just guessing, right? And within an entry model, you have a structured approach and a structured process that keeps you not only focused and disciplined but also consistent at the same time, right? It eliminates emotions from your trading and it ensures that you're only taking trades that align with your overall higher time frame narrative and context. That is precisely why an entry model matter, and that is why it is so important in your whole trading system or your trading arsenal. Now let's move on and let's break down the four main components of a strong entry model. Number one, market context. We know exactly how important market context is for your trade setups and your trade ideas. This is basically your foundation for your trades, right? Before you even think about entering a trade, you need to understand the broader market environment and the broader market context. You're going to ask yourself, what is the higher time frame direction? Is it bearish? Is it bullish? Or maybe you don't have a clear direction that you can look up to. And that way you're going to stay out of the markets and stay neutral and stay risk off without taking any trade idea because your directional bias is not clear. The next most important question regarding market context that you're going to ask yourself is, where is price in the current daily range that we have? Are we in discount region or we are in premium region? And do we have any key levels that we can trade off of? Then you're going to ask yourself, is the market in accumulation profile, manipulation profile, or distribution profile on the higher time frame? And that way you're going to decide whether you're going to you're going to be staying out of the market or you're going to participate in the manipulation or the expansion profiles. And answering all of those questions will help you determine your higher time frame market context, and then you're going to be making sure that you only take trades in alignment with the higher time frame market narrative or market context. Now, the second most important uh, component of an entry model is the trigger signal, right? The trigger is a specific event or condition that tells you that right now it's time to act and now it's time to enter or jump into the trade. That is what we call a trigger. It could be in the form of a liquidity purge, a turtle soup, or in maybe in the form of an order block forming, or maybe price reaching a key level or purging a candle range, right? These are the different triggers or the different events that helps us identify the signal that tells us that it's now time to enter the trade or execute the trade idea that we've been waiting for. For example, during the London kill zone, price purges the Asian range low, and along with that, it also purges below a 4-hour candle range and taps into a bullish order block on the 4-hour, and then it starts rejecting. Now, this whole event itself is your trigger to now look for a long entry, and that could be either in the form of entering a turtle soup entry, or maybe you could start waiting for an order block to be formed, and after that is formed, then you can enter a trade idea. That is up to you. The next main component of an entry model is the confirmation. Now, after the trigger, you need confirmation before entering the trade because this confirmation reduces false entries and improves your accuracy and precision. Now, you can also look for entry or enter that trade without a confirmation in the form of a turtle soup entry, but that is more suitable for advanced traders. But if you are a beginner or intermediate student, then you must look for a confirmation before entering a trade because without confirmation, you're going to face and experience a lot of false entries that are going to stop you out before price starts moving in the direction that you first predicted or anticipated, which will also mess up with your psychology and your whole mindset, and which is something that you don't want. That is why make sure that you always wait for a confirmation to form or a confirmation in the form of an order block forming or a fair value gap appearing, whatever, right? And then enter the trade. Now, confirmation can come in the form of, first of all, an order block forming at a key level. Second, a fair value gap appearing, right? Or maybe we have strong price action in which price forms a bullish engulfing candle at your key level or below or above a candle range, right? Now, the key point is that confirmation adds an extra layer of confidence for your trade, right? It ensures that you are protecting your capital and you are double checking the market's intention before you commit to the trade, right? That is the importance and the significance of waiting for a confirmation before entering a trade. After confirmation, the next component of an entry model is the risk management. Now, what you need to remember is that no entry model or no entry setup is complete without a clear risk management plan. Because a risk management plan or a risk model ensures that you're protecting your capital and you're staying consistent, right? And without it, no matter how good or how accurate your entry model is, you're still going to end up losing your capital in the long run because you're not consistently managing your risk. Trading isn't just about finding the best entries or taking the best trades, it's about protecting not only your monetary capital but also your psychological capital. Because if you're not taking or selecting the correct risk for your trades, then a single loss or a single losing trade can wipe up your whole capital, which will ruin and mess up your months and weeks worth of progress and performance, which is something you never want. That's why you're going to make sure to have a clearly defined risk management plan and a risk model for your entry system and your entry model. And a complete risk management plan and risk model is going to contain guidelines and protocols for your stop loss placement, for your position sizing, and also your risk reward ratio, right? These are the three things that you must consider in your risk management plan, and without any of them or either of them, it's incomplete. Your risk management and your risk management model or risk model is incomplete. So, that being said, a strong entry model isn't just about finding good trades, it's about avoiding the bad ones. And by focusing on market context and waiting for a clear market trigger and confirming your entries and managing risk, you're creating a process that's both reliable and repeatable. And that is going to ensure that you are consistent in your trading. Now, let's move on to the next slide. Here in this slide, we're going to dive into the prerequisites for using an entry model. Now, we know that having a solid entry model is good, but it's only effective as the groundwork that you lay before applying it. You need a clear structure or a checklist, if you will, that ensures that you are making decisions based on a solid logic and not just gut feelings. Now, let's go through each prerequisite step by step. First of all, we've got drawn liquidity. Drawn liquidity is about understanding where price is heading. The first thing that you need to nail down is the drawn liquidity or higher time frame directional bias. This is about identifying where the market is likely to move, because we know that the market doesn't just move randomly, it seeks liquidity, and your job is to figure out where that liquidity resides or where that liquidity sits. And that way, you're going to ensure that you only take trades that are in the direction of the higher time frame directional bias or drawn liquidity. Number two, we've got narrative. Narrative is basically building a story behind price movement, right? Once you've identified the drawn liquidity, you also need to build a narrative, right? A clear story that explains why price is behaving the way it is and what's likely to happen next and exactly in what fashion it's going to happen. The next thing that we've got is confluences. Confluences are exactly what separate high probability setups from random trades or low probability setups. And the more factors that you can align with your trade idea, the stronger your setup or your trade is going to be. Next up, we've got is timing, right? Timing is all about when to strike or exactly when to enter a trade idea or execute a trade setup. We know that timing is everything, right? Even the best setup can fail if you are entering at the wrong time, right? That's why your entry should align with the natural rhythms of the markets. And that's why you're only allowed to enter trades at specific times of the day or specific days of the week. And then we've got management, which is going to help you prepare for every single outcome, right? The final prerequisite is having a clear plan for managing your trade both technically and psychologically. And this is what keeps you grounded and consistent in the long run. Inside the risk management framework, we have to know our stop loss level, our position size, and our risk per trade for each account type. And within psychological preparedness, you're going to ask yourself, are you in the right mindset to take trades or not? And if you're emotional, distracted, or rushing, then you're going to take a step back and stay risk off. The key point is that managing or management isn't just about protecting your capital, it's also about protecting your mental state. And that's why it's such an important component of your entry model. The prerequisites for using an entry model aren't just a checklist, right? They are the foundation of consistent trading. And by focusing on liquidity, narrative, confluences, timing, and management, you are ensuring that every trade that you take is grounded in logic and supported by data. Now, let's move on to the next slide. So, now that we've gone through all the details and intricacies about entry models, what they are, how they work, why they work, and what are the requirements, and so on, it's finally time to discuss the top three entry models that you should be using. Now, there are other models as well, but in my opinion, they're not worth your time if you master these entry models that I'm about to explain to you. The first one is the turtle soup entry model, right? It's the most advanced one and requires the most experience, chart time, and technical knowledge. Therefore, you should be only using it if you are an advanced trader. The second and third entry models are the order block and the FVG model, which both requires confirmation and are more suitable for beginner and intermediate traders. Now let's discuss each one of them in detail separately. So moving on, here in this slide, let's first talk about the turtle soup entry model. Now remember, for each one of these models, you're going to do and follow exactly the same routine and mechanical approach that I taught you in the chapter before this. So the first and the most important thing about this model is marking a candle range or a CRT. You're going to select a candle range in the direction of the high time frame down liquidity, and that is going to basically act as an anchor point for you to frame your entry, right? This is basically a reference position for you. And once you've done that, the second thing is that you're going to wait for the candle range to be purged at a key time. After that, the third step is the entry, meaning exactly where are you going to be taking your entry. And once you've done that, the fourth step is setting the stop loss. And again, you're going to do that based on the framework that I showed you in chapter 24. And then last but not least, the least complicated or the simplest and the easiest part is setting your target, which is fairly simple. First of all, you're going to target the 50% of the candle range and then eventually the opposing end of the range or opposing end of the CRT. Now let's move on to the next slide and let's discuss an example. Right here in this slide, you can see this price action chart. On the left, we've got the higher time frame, and on the right, we've got the lower time frame. What you can see on the higher time frame is that we are in a bearish order flow because we are rejecting above highs and breaking below lows, and our directional buys and down liquidity is lower, which is precisely this low right here. So our objective is going to be to trade in the direction of the higher time frame down liquidity, which is this low right here. And to frame a trade idea, we're going to wait for a candle range or a CRT to be formed. And what you can see right here is we've got this high right here, and just below this high, we formed this for our candle, right? And after forming that, what happened is that the next candle straight away purged that candle high, and that candle precisely became our candle range or CRT, right? Which is going to act as an anchor point for us to frame our entry. So our key level here was this high right here and that order block that you can see on the left, and you can see that it was purged at a key time. So now on the lower time frame I'm going to look for a trade. As we are discussing a turtle soup entry, that's why the next step is going to be to take an entry straight away without waiting for a confirmation, because a turtle soup entry is taken without a confirmation. Our entry trigger right here was when this candle range high was purged and the high was taken, which is enough for us. Now the only thing that is left for us is to take an entry. On the lower time frame, you can see that first of all we've got the CBDR or the central bank dealers range, and along with that we've got this Asian range. What I've done here is that I've marked out the standard deviations of both the means. And what you can see right here is that we've got the 2.5 and the 2.5 standard deviation of both the CBDR and the Asian range aligning with each other just above this high right here inside this order block, this high time frame order block. So after the candle range high was purged, instead of taking entry right away, what we would have done is we would have waited for price to reach that 2.5 standard deviation level, and that is exactly the level that we would have entered the trade. So you can see right here that our entry would have been refined further, and we would have placed our stop loss at the standard deviation 3 level. And obviously for a tilde soup entry we are going to take that trade without a confirmation, so we would have straight away entered that trade with our stop loss at the standard deviation level of 3, and we would have targeted the candle range low. And this is what we call the turtle soup entry model. So not only we had the entry trigger and the protocols and guidelines for placing our stop loss and placing our take profit levels, but also you can see that it's also backed by the higher time frame market context and narrative. Now right here in this example I just showed you the market context of the 4-hour time frame, but when you are trading in real time you are also going to be making sure to integrate the higher time frame top down analysis from the monthly, weekly and daily time frames as well, and that way they'll ensure that your accuracy and precision on the lower time frame is even more than what it used to be. Now let's move on to the next slide. Next up we've got is the order block model. Basically it follows the same routine as the Tata Soup model, and you're going to be doing almost exactly the same stuff, but the only difference here is that you'll be waiting for a confirmation after the entry trigger before taking an entry, meaning now you've added an extra step here to increase the odds of success even more. You're going to be doing the same stuff. First of all, mark a CRT in the direction of the high time frame on liquidity. Then wait for a purge at a key time. After the purge, the unique step here is that you'll wait for an order block to form and then enter that trade at the open of that order block. Here, your stop loss will be at the extreme of that order block, meaning either the high or the low of the order block depending upon the context. And for target, you'll follow the exact same protocols and guidelines as the other one, which is basically you're going to put your first target at the 50% of the candle range and then your second target at the opposing end of the CRT. Let's move on and let's discuss an example. Right here you can see we've got exactly the same price action chart right here. You can see the higher time frame market context and thought process is the same. We are in a bearish order flow and our drawn liquidity and directional bias is lower in bearish. On the lower time frame, we have the exact same stuff in annotations. What price did is price purged the candle range high at a key time, and also along with that it also took out this high, which would have been our entry trigger to start looking for an entry setup. And as now we are discussing the order block entry model here, after the entry trigger we would have waited for a confirmation in the form of an order block forming. And right here you can see that after the purge, price came down below and closed below the candle that purged the CRT, which turned that up close candle into an order block. And after that what we would have done is placed our entry At the open of the order block, stop loss above the swing high or the order block high, and our target would have been the candle range low. This is what the order block entry model would have looked like. Now let's move on and let's discuss the third type of entry model. Last but not least, we've got the fair value gap or the FVG model, which is the second type of conformational entry model. It's basically the same as the order block entry model with just a small difference, which is that instead of an order block confirmation, you'll be looking for a fair value gap or an FVG confirmation, right? You're going to be waiting for an FVG to be formed instead of an order block, which basically adds another extra layer of confirmation and clarity to your entry and makes it even more high probability and the odds are even more. Now with this protocol you might miss some trades, but it will ensure that the trades that you actually do take will be up will be of utmost high probability, and the odds of those trades playing out correctly would be even more. You're going to follow the exact same steps. The only difference is that you're going to take an entry once an FVG is formed and then you'll enter there, and the stop loss will either be above or below the FVG or above or below the order block that is formed along with the fair value gap or FVG. Those were the three different types of entry models, right? They're basically the same with minor changes in their details when it comes to taking entries. The high time frame market context is going to be the same, the narrative is going to be the same, even the confluences in timing and the trigger. But the only difference is the confirmation aspects to these three different entry models. The first one doesn't have a confirmation, but the last two ones have different confirmations of their own. Now let's move on. So, now that we've discussed the entry models, let's talk about which model exactly to choose and which factors are you going to consider when making that decision. First of all, let's break down the turtle soup model first. Let's talk about what makes this model unique, why it is so challenging, and who are the traders and who it's best suited for. So right here you can see is that the first point that we've got is high risk, high reward. We know that the Tata Soup model is all about precision and accuracy. And with this model, you are stepping into the market at the earliest possible stage of a reversal, right when the market purges liquidity and starts moving in the opposite direction. And because you are catching the move so early, the reward potential is huge, but so is the risk potential. Now, the reason the risk is so high is because you are entering without a confirmation. You are betting on your ability to anticipate the reversal and predict the reversal. And if you are wrong, the market could continue in the same direction, which will hit your stop loss quickly, right? And take you out of the trade. But the reason some of us uh, prefer this type of entry model is because of the reward. And the reason the reward is worth it is because when you are right, you are in at the very beginning of the move, meaning you maximize your profit potential. And this model often leads to the best risk reward ratios, with trades offering higher than 1 to 5 risk reward ratio or even more. Number two, the second point is that it requires experience, intuition, and chart time, right? I've already said this before. This entry model isn't for beginners, right? To execute this model effectively, you need to have a deep understanding of the market behavior and market context and have enough chart time under your belt. The third point is that it has intricate entries and stop loss placements. One of the hardest part of the turtle soup model is setting your entry and stop loss, because unlike other entry models, this model requires precise execution and there's very little room for error. And the reason it's so challenging is because if your stop loss is too tight, then normal market volatility could take you out prematurely. But if it's too wide, then you are risking making your risk to ratio vague and not worth it. Number four, it requires no confirmation, which makes it vulnerable to manipulations. Here's the catch: the Turtle model does not rely on confirmation, right? We know that. And that way you're entering Right at the liquidity patch, which means you are more vulnerable to false signals or additional manipulations. Sometimes the market could fake a reversal and then continue in the same direction, and that way it could give you false entries and take you out once or twice before moving in your direction, and that could lead to some serious losses. In a range bound market, we know that liquidity grabs or turtle soup can happen multiple times before the real move occurs, and in those scenarios or those market conditions, it can lead to a lot of losses. So, having proper knowledge about the market behavior is extremely important. That is why it's only suitable and preferable for only advanced traders. But despite these risks, the Tata Soup model offers something that no other entry model can offer. It lets you catch the winning move right at the start. This is why advanced traders love it. You're not waiting for a confirmation or chasing the move, you're already in the move before most traders even realize what's happening or what's going on. But if you're just starting out, then this entry model isn't for you. The Tata Soup model is best suited for experienced traders who have a strong technical knowledge and have enough chart time and experience, because the ability to read liquidity and anticipate market reversals is extremely important, right? And also, you need to be psychologically disciplined and experienced to handle false signals and rapid stop loss hits. Now, you should only use the Tata Soup model if you are advanced, meaning you've spent significant time in the markets and have a deep understanding of liquidity and order flow. You are intuitive, meaning you can read the market's behavior and anticipate moves before they happen, and that comes with chart time and experience. And you are disciplined, meaning you can handle the pressure of rapid decisions and frequent stop loss hits without losing confidence or losing consistency. Now, let's move on to the next slide. Right here in this slide, let's talk about the order block model. Now, if the Tata Soup model felt a bit too high risk and aggressive, then the order block model might be the perfect alternative for you, because it's all about taking a conformational approach, right? And that conformational approach offers you moderate risk and reward while also protects you from common pitfalls like false signals and false entries. Now, the first point regarding the order block model is that it offers moderate risk and moderate reward. Unlike the high stakes nature of the Tata Soup model, the order block model operates in a sweet spot of a balanced risk and reward. You're not aiming to catch the absolute top or bottom of a move, but you're entering after a clear confirmation which significantly reduces your risk. Now, the reason it's safer is that you wait for price to create an order block and return to it, so you are only entering after the market has shown you its hand, and this reduces your exposure to false signals or rapid stop loss hits. And the reason the reward is moderate as compared to the Tata Soup model is because since you are entering the trade slightly later in the move, your profit potential isn't as high, but that's the trade off for a greater safety and more safety. Now, the auto block model is perfect for you if you prefer consistency and control over high stake gambles. The second point is that it offers a simple and mechanical approach. One of the biggest advantage of the order block model is its simplicity. It's a step-by-step, rule-based approach that doesn't require advanced intuition or years of chart experience. Number three, it protects you against manipulation. One of the standout features of this model is the ability to protect you from false manipulation or Judas swings, right, or other form of market manipulations. The conformational nature of this model uh, enables you to enter the trades only if the market has completed its manipulation phase or manipulation profile. Number four, easier execution with clear rules. For intermediate traders, execution can be the hardest part of trading, especially when emotion gets involved. And the outer blocks model's mechanical structure makes it easier to stick to your plan. Number five, vulnerable to missing moves. Now, the only downside of the order block model is that the order block model relies on price retracing to the order block, which does not always happen, right? If the market moves impulsively or explosively from the candle range or the key level, then you could miss out on some big moves, right? That's why it's the only downside of this model. So you need to consider these aspects in your mind when making this decision of whether you want to choose this model for yourself or not. Now, missing trades is part of the game, right? But your focus should be on the ones that you do catch and ensure that they are high quality setups and you end up winning them. Number six, it's best for intermediate to advanced traders. The auto block model is simpler than the turtle soup, but it still requires a good understanding of market structure, liquidity, and timing. So it's ideal for traders who have some experience and are looking to refine their execution with a more mechanical approach. These are all the points regarding order block model, the order block entry model. Now let's move on and let's discuss the last entry model, which is the fair value gap model. Right here you can see the different points of the FEG or the fair value gap model. First of all, it also offers a moderate risk and a moderate reward. It provides an additional confluence over the order block model, which provides you a greater precision. Also, with this model, you can miss trades too. If price doesn't retrace back to the FEG that you've marked out, which means you're going to miss out on some trades. And you can see that basically it has the same detail as the order block model, but with a small added confluence, which is the FEG itself. Right? You're not only waiting for an order block, but also you're waiting for an FEG to be formed as well before you strike and take an entry. Now, when it comes to choosing the right entry model, it all boils down to understanding your trading style, your risk tolerance, and your level of experience, right? Each model, whether it's the high risk, high reward Tersu model or the balance and structured outer block model, has its own strengths, challenges, and ideal use cases, right? The key is to align your choice with your personality and your trading objectives, right? There is no one size fits all entry model in trading. The best model for you is the one that matches your strengths, minimizes your weaknesses, and aligns with your long term goals. And what you should do is master one model at a time, refine your skills, and always remember that trading is a marathon and not a sprint.